Hey everybody, welcome to Talkenomics Live. I'm Adam Shapiro, and did you catch your breath today? When you watch these markets, it's almost like whip me, beat me, make me write bad checks. It's up, it's down, it's all over the place, and it's been like that since we first had tariff talk last month, but there have been other factors playing into all of this. So, did you catch your breath? Because today was a day where you could not only catch your breath, you could exhale. And let's look where we ended. The Dow was up roughly 1%, okay, 0.9%. We gained 383 points. We had the S&P 500 was up 1.1%, gaining about 60 points. My retirement is cheering because I am a passive investor. I tie things to the Vanguard Index 500, Fidelity Spartan 500, and I think our guest would probably say, Adam, shame on you for doing that. We'll get into that in a second. But we saw the NASDAQ. NASDAQ was up 1.4%, gained 246 points. We had the big NVIDIA event yesterday, and there's some people who say that Jensen Huang did not hit a home run, but as I pointed out earlier today, that man owns the stadium, doesn't need to hit the home run. And then, of course, we saw that stock go up today. We're going to talk about all of this. But right now, let's talk about what's happening in these markets, because we have two experts who are going to help us understand where this is all heading and how we should be thinking about positioning our portfolios. And our first guest tonight wrote something that jumped out at me when I was reading her bio, and it was this. What we are not seeing: negative earnings growth, IG spreads widening significantly, a pop in the put-call ratio, or a spike in 20-day lows. Recession calls are growing, but I'm not sure we have hit a tradable low as we wait for more signals to catch up. Please welcome to Talkenomics Live the woman who wrote that, Victoria Fernandez. She is the chief market strategist at Crossmark Global Investments, and she has many years, I think 15, 16 years plus experience in fixed income. And on a day when the Fed heads are talking, we need to talk fixed income. But Victoria, it's great to have you here. Thank you for joining us.
Yeah, it's my pleasure, Adam.
So did you catch your breath today? I mean, how do you just, we're up, we're down, we're up, we're down. It's that bad line about, hit me, hurt me, make me write bad checks. What is going on?
Yeah, I thought it was a very interesting day because the fear, in my opinion, out of this Fed meeting was that we were going to get a very hawkish tone to the Fed. They were going to be focusing on the fact that University of Michigan inflation expectations were much higher in the short term. They were higher in the 5 to 10 year as well. And so I think there was a concern that we were going to see a more hawkish tone come out. But that's not really what we got. You still have the Fed saying, look, we'll probably have 2 rate cuts. You have Powell talking about how they might look through a temporary jump in prices because of tariffs. And, he was actually asked the question, look, we said temporary before during COVID, are we coming back to this again? But I think the market took from it that they are favoring cuts coming later this year. The market took a little bit of a breath with that, and that's why we had the rally. And it's why we saw yields come down about 10 basis points on the short end and even about 6-7 basis points on the 10-year.
All right, so you have perfectly set up the soundbite from, I want to say Bernanke because I covered the Bernanke Fed, but the Powell Fed, where he was asked that question. There was this back and forth about sentiment data and hard data regarding inflation. And then he was asked the question about, is it transitory, and what we experienced during COVID, as you pointed out. And here's how he responded as to what's going to happen with inflation, especially with the potential for tariffs to hit. Here's what he said.
It's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment.
And so when he talked further, he talked about the Fed has to figure out how to separate tariff inflation from non-tariff inflation. The takeaway I had, and I am no expert, that's why you're here, what I heard was that they're not really concerned about tariffs and the current economic policy having a negative impact on the overall U.S. economy. Therefore, no need to raise interest rates, and why we got 9 of the dot plot voters saying let's have 2 cuts.
Yeah, if we dissect that, there's some truth to what he's saying in terms of The tariff itself would probably be a one-time jump in prices. So they want to look through that. I get that component. The issue that they have to be careful of, just like they saw in COVID, maybe it's not the tariff component, but it's the secondary results from that. If you get a fiscal policy that then becomes inflationary, if you get money coming to individuals, if you kind of stoke those flames of demand from people because you're trying to do things like cut taxes, do things that will help buffer the jump in tariffs, then you have an issue. And that's exactly what happened during COVID. So I don't think they can completely ignore tariffs. They have to look at what the whole picture would look like. April 2nd, Adam, is going to be a key date. It's one of the reasons that I say I'm not sure that we're at a tradable low, the quote that you used in the very beginning. If we see this current administration on April 2nd say, you know what, it's not just going to be reciprocal tariffs, we've got a whole nother plan laid out here, then I think we see the markets go lower and Powell will have to reconsider his comments.
All right, so what I'm hearing you saying, again, not an expert here, is buying opportunity is still off into the future because we're not at the lows. And in fact, the Dow was up at one point today over 500 points, but then we saw a sell-off, not a sell-off, but we declined. Right. Going into the close. So explain to me what was happening, and does this set us up for a continued sell? I haven't looked at where futures are going to be, but tomorrow when we open, are people going to be taking the profit of today off the table to line up for what you're saying after April 2nd?
I think you might see some people doing exactly that. When we had the most recent lows back on Thursday of last week, we sat around on our investment committee, we sat around the table and said we wouldn't be surprised to see a little bit of a bounce here, right? A little bit of optimism, people taking some things off the table, finding some things that maybe are a little bit cheap, but still in an uptrend, right? You don't just go in and buy anything. You really have to do your homework, look at certain names and add a little bit to your portfolio, but wait to go all in for a bigger pullback. And I think you're seeing some of that rotation from investors saying, let me take a little bow on some of these names while they're up today, take that profit off the table and then be ready when we see a larger pullback. A 10% pullback is not something that we should all be frightened of. I mean, we typically have that once a year anyway, and so we were kind of due for it. But it's the uncertainty around all the policies, whether it's fiscal, monetary, trade, regulatory. It's all the unknowns around that I think could drive us to a lower low.
Well, it was this quote, and I'm going to pull up the Fed statement where they said uncertainty around the economic outlook has increased. So you hit that nail on the head. But let me ask you this, and if we could, I'm not going to ask you to say yay or nay on Tesla, but if we can pull up Tesla today. This stock, and I was talking with friends this morning about this, year to date, the stock is down, I think, about 42%. But the last the last 52 weeks, it's up 35%. And there are people who love Tesla, there are people who hate Tesla. But it's one of those stocks that had been driving the S&P 500 higher, as was NVIDIA. So when I look at what's going on with Tesla, what would you say to a client who's calling you up today and saying, hey, Tesla's on its way back up, I want to buy. How do you, those of us who get excited, how do you put us into the world of reality?
Well, whether it's Tesla or whether it's any other stock, and you could probably put most of the Mag 7 stocks in this scenario, what we would say is let's look at the fundamentals. Have the fundamentals changed in this stock? Have the fundamentals moved to a point where we would either want to sell or we would want to go in and buy? We don't want to trade off headlines. That's where you get that whipsaw. That's where people try to chase the market and say, oh, the momentum trade is there, the animal spirits are there. And then we see those pull back and it all comes back to fundamentals. What does CapEx look like for Tesla? What does competition look like for them? With, tariffs on Chinese cars coming in, are they still going to be cheaper than Teslas? Are people going to go to those? You have to get down to some of the fundamental elements and see if it still fits in your portfolio. Do not trade off headlines.
So here was the other part of that discussion about Tesla today, because my brother had 2 Teslas. He loved the cars. He doesn't have them anymore. But Tesla's forward PE is 61. And I read an article today that pointed out the value of the company is something like $745 billion. But net income last year was roughly, $7.5 billion. That to me said, as much as I might love Tesla, that says to me, this is a very expensive stock, and I must be smoking something if I think I'm going to be able to sell it to somebody with that kind of, metric under it.
Right. In an environment where you're not exactly sure what those forward earnings are going to look like because there are quite a few headwinds the company's facing, I would much rather go into a sector where I'm paying maybe 14, 15 times in healthcare, or even 10, 12 times in some financial names where those names are in solid uptrends. That would be a place that I would rather go to than paying 60 times in an area where I still think there's a lot of uncertainty to come.
I want to remind the people who are watching on X, on LinkedIn, on Facebook, on YouTube, and on Rumble that you can ask Victoria questions. We're going to bring our next guest in soon. You're going to be able to ask both of them questions you want. If you have questions about markets or not about timing a market, that's what I'd like to do, but we can't. But the questions that all of us are thinking, because these are the people who live this day in and day out and have done it successfully for several years. I want to ask you, Victoria, right now, what are perhaps the top 1-2 questions you're getting right now from clients?
Yeah, so a lot of our clients are asking, do they need to sell out of a lot of things and just sit in cash and wait for that lower low that we talked about a minute ago to go back into the market? Obviously, when you just talked about timing the market, we don't want to be chasing the market. So we can do some rotations within the market to help them depending on their risk tolerance. But you don't want to just go to cash and sit and wait. That's usually a fool's errand. And we also get asked about specific names, these MAG 7 names, and what we think about them and the longer term viability of those names within a portfolio. So those are the top right now. Once we start doing our quarter end meetings, I have a feeling we'll get a lot more questions around tariffs and what we expect from there.
And before we take our first break, I want to ask you, because your expertise is in fixed income. And I am somebody who does position some of the portfolio for our household with fixed income.
I'm so glad to hear that.
Yeah. Oh, yeah. It's well, you're going to hear that I'm probably overly conservative and have been for far too many years. But when I'm watching yields go up and then today yields dropping, that's where I get kind of what's going to happen here, because if you're laddering different treasuries and that's when I'm calling our folks and saying, what do we do here? And they say, don't worry about it. And we'll call you in 6 months when this one matures. What would you say to people like me paying attention to what's happening with yields and what we can surmise from this Fed statement today about where those might be heading?
Yeah, so I think if we look near term, we think yields will probably go lower before we see them move much higher. And we've probably hit the high in yields so far this year, with the 10-year hit a 480 earlier this year. That's probably going to be the high. And so I would try to take, based on people's risk tolerance, we always want to say, look at some of the shorter term part of the yield curve and lock that in, but you don't put everything there, because like you said, when it matures, you don't know where yields are going to be. So barbell that, meaning take some money and put it on the longer end of the curve as well, and lock in some of these 4.5% rates you can get on the long end for a few extra years, and just accept that cash flow coming in that can be a good buffer for equity volatility.
All right, Victoria, we're going to take a break. And Victoria's going to be with us when we come back after the break, but she's going to get a little bit of a respite here because we're going to bring in Eric Diton after the break, and we're going to have a one-on-one with Eric. But then I'm going to bring the two of them together, because what Victoria's just laid out for us are the kinds of steps you should take as you're heading towards retirement. And that's one of Eric's specialties, is helping people prepare for that. He also wants to talk markets. So we'll take a break. We're going to come back with Eric Diton from the Wealth Alliance, and then we're going to bring Victoria and Eric together, and we're going to have our little free-for-all. Victoria, we'll see you on the other side of 30 seconds.
Sounds good.
Welcome back to Talkenomics Live. We're talking about what happened in the markets today. We're talking about what Jerome Powell and the people at the Federal Reserve did today and the comments they made, with everyone still expecting, at least 9 of them expect us to have 2 more rate cuts this year. And we want to take the discussion about what happened in markets to the next level. We're going to keep talking about the markets and how you position your portfolio. But now we're going to do it with the end game, because when I started in this business, I didn't think about the end, although I fortunately had some good guidance. But now I'm closer to the end than I was at the beginning. And that's why we invited Eric Diton. He is president and managing director of the Wealth Alliance. He has over 38 years of experience as a financial advisor, recently named to the 2024 Forbes Best in State Wealth Advisors list. Eric, really appreciate your being here, and wish I had met you when I was a much younger man, because I think our portfolio for the future would be a lot better. But I don't want to jump into retirement just yet, because I imagine the clients that you have call you on a day like today, where we've had a couple of weeks of volatility, and then we have this dramatic increase after what the Fed did. And what are they asking you when we go through this whipsaw?
First off, thanks for having me, Adam. It's great to be here. And thankfully, we are not getting a lot of calls. Our people are not that worried. They're extremely diversified. We have trained them. And they're really very comfortable. And occasionally we just get questions like, hey, should we be changing our strategy? And this is all coming from that big word that we keep talking about, uncertainty. And I want you to understand that the Fed Beige Book that came out earlier this month mentioned the word uncertainty 47 times. That is more than the COVID era. That is more than the financial crisis in 08-09. That is more than when the tech bubble popped in 2002. So we are truly in unprecedented uncertainty, at least with regard to the Fed.
I'm glad
manifesting itself when you see consumer sentiment numbers and stuff like that. People are nervous.
Yeah, people are nervous, but I'm glad you pointed that out, because it's almost, I'm not going to criticize my colleagues in the press corps, because they have a tough job, and the people in the press lockup. I did that back in the old days at Treasury, where they would phone it and then we would call it in, they rang a bell. But when you point out how many times uncertainty was mentioned in the Beige Book, and yet today everyone made a big deal out of uncertainty around the economic outlook has increased, as if, oh my gosh, it's the first time the Fed has said that. But when you hear that, and you mentioned your clients understand, okay, uncertainty, but that doesn't mean you jump ship. And you pointed out, I mean, you and I are old enough to remember 1987, 2001, 2008, 2020. I mean, and we're talking about greater than 30% drops in those cases. When I hear people say this time is different, when you hear people say that because they think this time is different, is it?
Yes, it's actually different every single time, but it doesn't change the rules. So you can control risk in 2 different ways. You can try to jump in and out of the market. That's been proven time and time again. It doesn't work. Warren Buffett says he can't time the market. I consider him the greatest investor in history. If he can't do it, we ain't doing it. So how are we going to control risk? Through diversification. The only free lunch in investing is diversifying, finding assets that don't correlate. What does that mean? Assets that don't do the same thing at the same time. God willing, over a long period of time, they all get from point A to point B. They just do it at different times.
So let's talk about one of your expertise, which has to do with retirement and getting people ready for retirement. And I used to cover, part of my duties at Fox was I had a retirement beat. And this was years ago, but there was a public pension crisis. I don't know who in the United States has a private pension anymore. I mean, public sector people do, but I think less than 9% of the people in the private sector have pensions anymore. And we went to the 401k system. And I think the statistic that I pulled up, it's the organization, I can't think of the name, but out of Boston, the retirement center. 73% of working Americans have access to some kind of retirement vehicle, whether it be a 401k or those few private pensions that still exist. But only 53% take part in the vehicle that's available to them. Are you seeing that in real world numbers?
I'm not seeing it with my clients because I beat them over the head and I say, pay yourself first. Before you do anything else, get money in that tax deferred
Right.
or tax free, depending what kind of plan you're in. Get money in that plan. Listen, Adam, there are two major forces working against all of us in our quest to retire. They are inflation and taxes. So if you could pay yourself first and get money in that retirement plan, and Uncle Sam can't touch that money for 20, 30, 40, 50 years, that is huge. So we've got to do that. That's step number one. The issue is also that we are now responsible for our retirement. As you said, the pensions are gone.
Mm-hmm.
Our life expectancy has gone from 68 in 1950 to 79. We're living longer. The money's got to last longer. We don't have the pension. We are now responsible for our retirement. So who's training us? Who's teaching us how to retire? No one. No one's teaching us how to do it. Go back to college. Think of the most ridiculous elective that you took in college. For me, it was sociology of the family.
Mm-hmm.
Imagine if you took that elective and replaced it with how to manage your money and plan for retirement. Our success rate would probably be way higher. It's not in our society yet. I don't know why. They should teach it in high school.
Mm-hmm.
In Long Island, I used to go to the high school and I would teach the kids after school about retirement. I taught retirement classes for 12 years at night after I worked all day to adults. But there's just a real problem in this country. We're telling everyone you're responsible for it, but we're not going to tell you how to do it.
The way I would, that lesson, and I was fortunate enough to have two older brothers, one of whom went to Wharton and used to hit me over the head. You need to do this. When I was very young. You might have gone to school with them. We'll talk after the show. But I had access to a 401k. And by the way, 401ks have only been around since it was Ted Benna invented them or found the line 401k within the tax code in 78. But he never intended it to be your sole retirement vehicle. But long story short, I had access to a 401k. I funded it when I was a young reporter in Indianapolis. And then I left that job and I took that money and I was able to put it into the Vanguard Index 500. That's what my brother at Wharton said. And then in 99, I think the U.S. government, if you paid taxes, you could convert to a Roth, and I did that. Haven't touched that since. But I know what I put in 1999 is not what I got now, because what I got now has a big smile on my face, and I haven't touched it. And so when I think about 401ks, it's not the only retirement vehicle, but even better, on a day when the market's down and you get a paycheck, if you're doing the 401k, your employer, if they're matching a percentage, is paying you when the market's going down. So the point you're making is if you're going to do some dollar cost averaging, this is the way to do it through the 401k, right?
Correct. And we all know it's hard to save money. We all have all kinds of expenses and kids going to college and God knows what. So if someone can take the money from you before you get it,
mm-hmm.
that is the only guaranteed way to save money. And that's what a 401k does. That's why it works so well.
How often should I be having a discussion? Because we have someone who does our finances for us. But how often should I be meeting with that individual to either rebalance what we've got going on? And it's not all in equities. It was when I was much younger. It was all in high-risk equities, but then we started sending some money aside. I think I shared with you when we spoke a week or two ago that I did something that my friends on Wall Street said was foolhardy and stupid, and I won't get into the full details, but we have an annuity. It's not the entire retirement, but it's a portion of the future retirement that's guaranteed as long as that insurance company, which has been around almost 200 years, doesn't go belly up. What would you say to a client who comes in and quotes the guy on TV and says, I would rather, get on the Titanic than sell an annuity? Isn't that something people should consider, though, as they're close to the final part of work, as a way to secure some income in retirement?
So the answer is maybe. And it really depends on your personal situation, number one. It depends on your temperament and how you deal with volatility. We have data We have seen data that people left to their own devices in their 401k plans, they sell low, the markets go down big, they get nervous, they get their statement, they panic, they sell. The market goes up, the market's going up, all of a sudden they've got FOMO, and then they're getting back in and they're buying high, and so their returns are awful. If you're one of those people and you're an emotional investor, then a guaranteed income can make a tremendous amount of sense for you. So it really just depends on who you are as an individual. But you asked before about, when should we be reviewing, how often? And so the first of all, the first step, because I said no one knows what to do with regard to retirement. Mm-hmm. The very first step is have a plan. This is the age-old saying, people don't plan to fail, they fail to plan. Mm-hmm. And what does that mean? We do something called a data gathering. And by the way, 67% of Americans age 50 to 74 admit they have absolutely no retirement plan. They don't, nothing. They don't know what they're doing. Got to sit down and make assumptions about spending, about retirement, about longevity, about inflation, about taxes. And we run it. We put it to the test. Then we do a Monte Carlo analysis, which means we even change the order of returns and we get a percentage of success and failure. But what comes out of it, especially for younger people, is a number. If you want to do all the things you just said, you need to save X amount per month. Everyone should know that number. Now, they might come back and say, that's impossible. We can't do that. All right, then something needs to change. You need to spend less. You need to retire later. But let's find that out way earlier.
Right.
And not after people have retired. 37% of retirees have no savings left.
So let's take a pause there, because that's a perfect way for us after the break to bring Victoria back in. Because if you two you're successful in your different offices in different parts of the country, but if you're having this discussion, if I had sat down with you and it's how do I make those numbers work, I'd then go to Victoria and say, okay, let's put this together. Given this data that we have today with these markets, what do I do next? Remember, you can ask both of them questions. We are live on X, we are live on LinkedIn, we are live on Facebook, Rumble, YouTube. Send your questions in, because we're going to bring both of the experts together after the break, and we're going to start dissecting, okay, so what do we do now with what's on the table in the markets as we head towards retirement, or whatever it is you're heading towards? What do we do with our money? We'll be back in 30. Welcome back to Talkenomics Live. Our guest tonight, Victoria Fernandez. She's joining us from Crossmark Global Investments. And we've got Eric Diton. He is from the Wealth Alliance. And we've been talking with them about how do you position your portfolio? And we do this all the time when markets are moving. But with Eric, we're bringing into the discussion, what is the number? And this was a discussion I had years ago with somebody like you, Eric, who said, okay, Adam, what's the number that your family's going to need when that day comes per month, and how do we make that happen? So, Victoria, let me start this part off with you, because we finished with Eric saying if people don't know the number, once they know it, they might say, well, that's impossible. I can't get there. That's when I think I would turn to you. Here's our spending plan. Here's our investing plan. And I would say, what do we do? Have you gotten a question like that? And how do you respond to those people?
Yeah, we absolutely get questions like that from clients. And a lot of it, as Eric had mentioned, really depends on their risk tolerance and how much they're willing to kind of roll the dice on the markets. I mean, I remember you were very kind in the beginning to say I'd been in the business like 15, 16 years. So I appreciate that. It's actually been probably a decade longer than that. But I remember probably about 20 years ago, I had a client that said, I don't want to buy a treasury until the 10 years back above 7%. Well, what has she been doing with her money the last 20 years? Because we haven't been there. And so I think you have to talk to clients and say, let's find that diversification that you guys have been talking about in a manner that helps achieve those goals they have. And there's lots of ways to do that. You can do it with different equity income strategies. You can do things like covered calls to generate more income if you need a steady income flow. You can have the cash flow from fixed income. You can add equities. You can have alternatives. You can do long, short. There's all sorts of things you can do for a client to help them reach their goals. So they would work with their financial advisor. That advisor would work with us, and we would try to build that portfolio for them where they don't have all their eggs in one basket, and they can rest a little bit easier knowing there will be ups and downs, but over a certain time period, hopefully they can meet those objectives.
Eric, you were talking about the number, and then we've just heard Victoria talk about ways that you can lay that out. But when you're having a discussion with, say, someone like me who comes in who really does not understand the detail that the two of you have, should I be focused on, do you tell people to focus on asset preservation at retirement and after, or asset preservation while still generating income so that you can leave people something after you've left this earth?
Look, we want to try to get people the maximum return that we can without violating their personal risk tolerance. So let's just say someone comes in and they've got $1 million. First thing we're going to do is we're going to say, all right, we're going to ask you the traditional way. How would you define your risk tolerance? Conservative, conservative to moderate, moderate, moderate to aggressive, or aggressive? And they might say moderate. Now, one thing we know is there could be 20 people in the room, and moderate to one person could mean something very different than moderate to another person. So we got to go further. We got to say, look, in order to grow this money, there is going to be volatility. There will be periods of time where your statement's going to drop and your assets will be down. Let's talk numbers. What if your assets drop 10%? And then I say the number. Your $1 million drops to $900,000. Are you okay? Do you sleep at night? Can you stay in the plan? Yeah, I can. Great. What about 15%? And so on, until we get to the point where the person says, you know what, 25%? No. Good. Now we can go back in history and blend assets together in a way that while there are no guarantees, we feel very confident that when things go bad, we're not going to violate that downside.
If either of you wants to pick up on something that the other has said, feel free to do that. I want to read a quote because we were talking about Dan Ives from Wedbush, who covers Apple and he covers tech and NVIDIA. And he's well respected like the two of you. And he said something recently about NVIDIA. And I want to read what he said in a note to his clients after Jensen Huang's keynote address yesterday. And he said, basically, NVIDIA's chips remain the new oil or gold in this world for the tech ecosystem, as there is only one chip in the world fueling this AI foundation, and it's NVIDIA. So I'm going to throw this question based on what I just read, first to Victoria, then to you, Eric. As a neophyte when it comes to investing and understanding these things, I hear something like that, and I would be going to you, Victoria, and saying, we need to be in NVIDIA. We need to be in AI, and there it is. What would you say to me?
No, that's exactly right. You know, when my daughter was in high school, I went and spoke to her. They actually had an investing class. And I went and spoke, and I did this whole great presentation. And then one kid raised his hand, and he said, but how do I invest in penny stocks? And I thought, oh no. So people like that. They want the hot dot. They want what's happening in there. What we do for our clients is we're invested in some of these names, but maybe we're underweight what the benchmark has for those. I mean, those Mag 7 stocks, the top 3 to 5 stocks are almost 30% of some of these benchmarks. We don't want to put that much risk into someone's portfolio. So you can have exposure to some of these names, but we want to talk to our clients and say, yes, you have that in your portfolio, but we want to give you some other areas that we think are going to do well also and blend all that together. So everyone likes to chase the hot dot, but you do have to take a step back, look at it on a more holistic view. And being a bond girl, I'm going to come in there and tell you, you need that steady cash flow from some fixed income and put some money to work there. Because as we have seen, NVIDIA or any other stock can change on a dime.
And you know what, Victoria, when you said hot dot, you just brought me back to 1999, and I was getting a call a day on Cisco.
Yeah.
Eric, I want to buy Cisco. I'm reading everything. We've got to put it. Cisco is the future. Well, we all know Cisco peaked, I think, early 2000, and today we're still nowhere near the price that it was at the high. And had you put a good chunk of your savings in there, you would have demolished your retirement plan.
Polaroid.
So retirement plans aren't based on big bets. That's not how it works.
I just made a bad joke. Polaroid was one of those. Before any of us were old enough to invest or even alive. So let me ask you this, starting with Victoria. This back and forth about positioning your portfolio. At what age would you recommend people, let's start in your 30s, take it through to, you withdraw from the work world. What percentage would you advise your clients to be heavy in risk? And at what point should they start looking at the treasuries and the fixed income to balance out what they're doing?
Yeah, so even when I was in the early stages of my career, I always had a little bit of an allocation to fixed income because it would help buffer the equity market when there was a tremendous amount of volatility there. And then as I got older, as I am getting closer to retirement, not there yet, still got to put my daughter through law school, but as we get closer to retirement, you can start shifting those allocations, increasing some fixed income, but you still want to have equity. You want to be able to participate in those higher returns that you usually get from the equity market and balance it off with other things that you have. It's why I mentioned a moment ago, you can also look at alternatives as a way to help balance that out. So it really comes back, Eric used the word, a while back, that diversification in the portfolio. You can have more risk when you're younger, but I think you're not going to go in every quarter, right? And change your allocation. But at least once a year, you sit down. What is my risk tolerance now? How do I want to shift that? Maybe you don't change it at all and you let it sit for a couple years and then you start moving it. So I don't think there's a certain age because everyone's risk tolerance is different, but you start off heavier weighted on those equities. As you get closer to retirement, have some more of those steady cash flow type of instruments in your portfolio to generate that for you.
And I'd like to just go one step further, Victoria. I agree with everything you just said, but the way I see it is actually a U shape with regard to equity allocation. So what Victoria said, which I agree with, as you are getting closer to retirement, you're reducing your equity exposure. You don't want to take as much risk. You're going to need to start drawing from your assets. However, there may come a point in time where you recognize that even if the stock market were to drop 50%, you have way more than enough money to accomplish your goals. And in fact, a decent amount of your savings is for your children and your grandchildren at this point. And in that case, you actually can increase your exposure to stocks because you're now investing for the next generation with a much longer time frame.
Yeah, I think rarely would you ever want to say you're 100% fixed income. Maybe someone that's super, super conservative on their finances, but probably not. I have a coworker that says if he manages his money properly, the last check he ever writes will bounce. And I think that's probably a good way to look at it.
Oh, I like that. So I'm going to throw a real world scenario out to two of you, and feel free to say, Adam, you did a bad thing, or I won't be hurt. Eric brought up risk tolerance. I'm going to start this with Eric first, because I don't have tolerance for risk, although I have been in equities for a long time. But when I left a position at a TV network, I had a pension. And the choice I had was to leave the pension or to take the pension and either invest it or roll it over into an annuity. I chose the annuity one because it wasn't everything, but I chose the annuity because I knew me. I know what a worrywart I am, and I don't stomach downturns well. And I wanted to make sure we had a foundation in the future along with everything else. So we put the money into the annuity. The other day, I ran the numbers. If I had put the money into, let's say, the S&P 500 or into an index fund, it would have been a lot more in overall amount. But then I did, okay, if I started subtracting on a monthly basis a certain amount of money, how long would that have lasted? And it wasn't that much different. So where I'm going with this, Eric, is, Eric, would someone like me, would you advise them to do what I did 4 years ago? Or would you say, nope, you really should still be in the markets? And this happened at a time when I was 52.
Based on what you just told us about your risk tolerance and your aversion to risk, Adam, your decision was exactly the right one. You want that guarantee. That helps you when your head hits the pillow at night. You're sleeping well at night because you know you got that guaranteed income. That's what's there for. Good job.
Tell that to my friends who are all hedge fund guys. I have a dinner with them every December, and they're like, yeah, you should have done this. Victoria?
Well, I think if a client is speaking with their financial advisor and that is their situation, they know each other well enough to be able to say, maybe you don't earn quite as much, but you sleep well at night. I would rather earn a little bit less and be comfortable knowing that I can live the rest of my life with what I have in my nest egg than to have ulcers because I'm so concerned and I'm watching, financial networks all day, every day and pulling my hair out. No one wants to live like that. So I do think it's a very individual decision that has to be made between someone and their advisor. And then we're there to help invest the funds the way that they want them to be invested to help them reach their goals.
I'm hoping I still have the hair to pull out as time goes on. But let me ask you this. So the follow-up to this is I'm not sure I would make the same decision today, even with the volatility we experience. If I had I might go another route. But again, it's not the full thing. It's a smaller percentage. But as people approach that last year of work, they're being confronted with, this is what you got in the 401k, and they have to make decisions, Victoria, about, okay, do I leave this in, income producing or at least asset growth producing assets or equities, or do I annuitize some of it? Because that's now an option in some 401k plans. How do you advise them?
I think a lot of that has to do with where rates are at that particular point in time. Do you have rates on an annuity that are high enough to meet the needs that you're going to have for cash flow? And do you worry about when that comes due, where rates will be at that point? And then you have a ton of reinvestment risk that you have to decide upon. For us, that's why we like to kind of spread it out a little bit. It doesn't have to be a laddered portfolio. We look at the shape of the yield curve. We determine where we think clients can do best and put money to work in different areas so they can take advantage of shapes of the yield curve, what yields are doing. In my opinion, that's probably a better way to do it, but that doesn't mean that an annuity can't be part of that allocation if it makes that person feel a little more comfortable.
Eric, doesn't bond laddering accomplish the same thing as an annuity, though?
Yeah, I want to just add one more thing there. So what you're talking about is a QLAC, right? A qualified longevity annuity contract. Mm-hmm. And there is another interesting wrinkle in there. And that is, we all know that there's something called an RMD. We have to start taking a required minimum distribution from our retirement account because the government's saying, we haven't taxed that money, but it's time. You got to start paying taxes. But if you put money into this QLAC, this annuity, you can defer your RMD as long as age 85. So there are some high net worth people who don't want to take the money out of their retirement plan. And instead of being forced to do so, they will buy a QLAC so they can defer maybe another 12 years before they've got to start taking money out of the plan. Just want to throw that in there. It's interesting.
No. What's interesting is I should have invited into this program my tax guy, because it wasn't quite that discussion, but there were. This is why you need people like Victoria and Eric and my tax guy, because I had no clue about the ability to exceed the contribution to your 401k. Legitimately and legally. I can't even explain what we did, but I did it at a different job because the law allowed it. and there was a tax ability to do it, and we did it, and it's a Roth IRA now, but life is good. Let me wrap up with this. I'm going to throw it first to Victoria and then to Eric. What is it you want to leave people who are watching with where we are at this point? And I want to bring up something that Eric said earlier when I said, we always hear this time is different. And then I asked him, is it? And he said, it's always different. Yet the strategy seems to be, you got to be patient and not panic. So that's not different. Victoria, what's your closing thought?
Yeah, things can be different, but they still rhyme, correct? That's kind of the phrase that we hear people say. And I think you have to look at it and say, okay, we've had a correction in this market. We've pulled back 10% on the S&P and on the NASDAQ. We've had things that tell us growth may be slowing a little bit, but that's not so uncommon. I think we just have to take a step back, look at it from a high level and say, when there is uncertainty in the market, where do we put our money to work? What are the sectors that we think have potential, that are still in uptrends, where the names in those sectors are still making highs, 20-day highs? Those are areas where you want to put money to work. Do you want to set more aside right now? That's something Eric could help them with. So I don't think it's a time for people to be scared. I do think it's a time for people to be cautious and maybe put a little more defense in their portfolios and the types of names that they're buying on the equity side, and maybe add a little more fixed income so that they can have that buffer there as well. So they don't need to go to bed being scared, but I do think they can be positioned defensively, and that will help them make it through these volatile times.
Eric?
So think back to the first time you cooked something for dinner, the very first time you cooked something.
Caught fire.
I'm sure you messed it up. It did not taste good at all, and it ended up in the garbage. And you know what? It didn't matter, because you tried it again the next time, you did the next time. Sooner or later, you got a lot better at it. With retirement, you don't have that option. You have one shot. And if you blow it, you blew it. So I'm going to reference the license plate that I had for many years in New York. Have a plan. Have a plan. Not something in your head. I'm talking about a written plan that you can look at and you can update on an annual basis. It doesn't guarantee success, gives you a much better chance of getting there.
The insight the two of you have, and I'm grateful that I've known people along the way who guided me, because to Eric's point, to Victoria's point, you got to ask people the things that were not being taught in school. We didn't, they had eliminated home ec when I was in middle or high school. And I think these kinds of discussions or lessons are what they taught in home ec. So with that, I want to thank Eric Diton for joining us. He is in what my people call the promised land, Boca Raton, Florida. Victoria Fernandez, good luck with the college bills and the daughter going through law school. I really appreciate you both being here, and I hope you'll consider coming back, especially Victoria, when we do hit that point where you think it's time to go and get back into the market. I would love to get your assessment on that. And Eric, when you see some things happening on not only the markets, because I brought you in as a retirement expert, but you're also a portfolio. You manage money. So if you see an opportunity, please let us know, because I'd love to bring you back in and get your insight. And thank you both for being here on Talkenomics Live. We're going to post this to the website so that you can watch and hear some of the insight that they had if you missed something. And we will be putting posts out on social media. Until next Wednesday, you have a great evening, everybody.
Thank you.